Welcome back to another video, everyone. In this video, we are going to break down flag and pennant patterns. We are going to go over what are flag and pennant patterns, types of flag and pennant patterns, and how to identify and trade the flag and pennant patterns. So first and foremost, what are the flag and pennant patterns? These are trend continuation patterns that are formed when the market consolidates after a sharp move up or down. So whenever a stock makes a sharp move up or sharp move down, these two patterns kick in, which are continuation patterns that make the stock take a break before the stock continues that trend, right? Before it continues that trend. Now, there's four types of these different patterns. So the first one we have is a bull flag. Let's just focus on this right here. A bull flag is when a stock makes a major move up, takes a break, and then continues. Now, after the bull flag, we have something called a pennant pattern, right? We have a bull pennant. These two they're basically the same exact thing. Now, if you look at the same exact thing, the only difference is the formation here looks like a flag and the formation here looks like a pennant. But the idea behind both of them are the same exact thing. Stock makes a major move up, stock makes a major move up, takes a break, continues. Same idea, just has a little bit different formation. Beyond that, we have a bear flag and we have a bear pennant. It's the opposite. Stock makes a major move down, needs to take a break, continues. Once again, these are the flag and pennant patterns. The bull flag and the bull pennant are basically the same exact thing. Just the formation right here is a little bit different. The bear flag and the bear pennant are the same exact thing as well. Same idea, same formation, same idea that's happening here. It just looks a little bit different. The main thing I want you guys to take away from this is the idea behind the patterns. Right, now let's go to the idea behind the pattern and break down the psychology of flag and pennant patterns. The flag and pennant patterns highlights a trading environment where the supply and demand balance has shifted badly in one direction of the market. So basically, the supply and demand aspect shifts very aggressively. So you can see a lot of supply, not a lot of demand, a huge shift, takes a break, continuation. Now, the story behind this is the stock is surging up or down on high relative volume, usually from news catalysts. Sometimes there is news catalyst. If there is, makes the play a lot better. So in this situation, let's say the stock makes a big, aggressive, strong move down. We see high volume, nice candles, nice strong candles, showcases bears are in control. Now, if bears are in complete control, there's high volume and a huge move down, that's a good sign. Now, what tends to happen is the stock needs to take a break. As it takes a break, it consolidates into a flag-like pattern in this situation. So price consolidates at near highs or lows. In this situation, near lows with defined pullback pattern. Makes an aggressive move down, takes a break, pulls back, and then buy or short when this price breaks above or below the consolidation pattern on high volume. So as soon as it breaks this point right here, or this point, depending on the play, you can take on the trade and then place your stop below bottom of consolidation pattern, wherever the consolidation is, and I'll go over that in a bit. But once again, the whole idea is bears are in complete control. They take a break, and they continue direction. This can happen on the downside, or it can happen on the upside. That's the psychology behind it. What I want you to take away, once again, is the understanding behind the pattern. So when it showcases in different forms, you can still identify it and trade it because you understand the meaning behind it. Now, let's break down the first pattern. The first pattern is a bull flag. So what is a bull flag? A bull flag is a chart pattern that happens when a stock makes a strong move up and then takes a break. So stock makes a strong move up, forms a pole-like formation. As it makes a strong move up, the stock once again needs to take a break. It needs to consolidate. When it takes a break or consolidates, it forms a flag-like pattern, right? If the stock breaks the trend line resistance, which is right here, this red line, if it breaks the trend line resistance on the flag, there's usually a possibility that the stock may continue moving up. Now, there's a lot of different ways to trade this. Some people like to trade this when it breaks the trend line formation. Some people like to trade it when it makes a new high or breaks the last resistance point. That's up to you. That depends on the trade. That depends on what's presented in front of you. A lot of different variations are there, but just understanding the pattern itself is very, very important. That's what we're going to focus on for now. Once again, strong move up, takes a break, continues. Here are some examples. You guys can see right here, stock makes a nice move up. You can see as it starts making a nice move up, look at volume. Volume starts picking up. Boom. Where does volume start decreasing? Volume starts decreasing when the stock starts pulling back. That is a good sign. There is a difference. Once again, if volume was going up while the stock was going down, that would be a sell-off. That would be a bad thing. The reason this is a good thing is because stock goes up, high volume showcases commitment, showcases people are interested. When the price starts going down, right, and volume starts going down, it showcases not a lot of people are interested in selling. Not a lot of aggressive sellers are sitting there, right, which is a good thing. And the moment this breaks this level, right, breaks the trend line and continues, you can see volume starts slowly picking up, right? Well, volume picks up, takes a break, continues, and that is showcasing a continuation of the play. Volume increase. You can see stock makes a move up, bull flag, continuation, right? Here's another example. You can see stock makes a strong move up. What's one thing we want to see when a stock makes a strong move up? We obviously want to see high volume. Now, when it pulls back, during this time, we want to see low volume. That would confirm the pattern. That would be one of the features that we would want to see. We would want to see the stock having low volume on a pullback. We always want to see low volume on a pullback because that gives us a confirmation that this may possibly go back up. If you look at this trade, your entry's right there. Some people, once again, like to enter on the break of the trend line. In this situation, I would personally wait for the break of the high. This would give me my entry, and obviously this would give me my stop point where I would exit for a loss. Next, we have a bear flag. A bear flag is the opposite. Bear flag is a chart pattern that happens when a stock makes a strong move down and then takes a break. So basically, a stock makes a strong move down and then takes a break, right? Looks like a flag-like pattern. You can see the pole, the flag, right? If the stock breaks the trendline resistance or trendline support on the flag, there's usually a possibility that the stock may continue moving down. If it breaks this support level, there's a high probability that it may keep moving down. Let's look at some examples. Right here, we can see strong move down, nice volume. Look at the pullback. As it starts pulling back, look what happens to the volume. Volume starts going down. That is a strong sign. Right when it breaks the trend line, as soon as it breaks the trend line, volume increase, volume increase. That is showcasing strong, aggressive selling. Entry point right there, and you can put your stop. Once again, multiple ways to trade this. Some people would rather trade this on this level, but it all depends on the stock. There's no exact criteria on when to trade it, but these are 2 points you can trade it, and every single stock will obviously showcase different entry points depending on the situation. Here's another bear flag example. You guys can see stock makes aggressive move down, takes a break, and continues. Next, we have a bull pennant. A bull pennant is a chart pattern that happens when a stock makes a strong move up and then takes a break. So you can see right here, stock makes a very strong move up, right? Stock makes a very strong move up here. As it makes a strong move up, it takes a break. Very similar to the flag pattern. The break looks like a pennant, right? So this break looks like a pennant formation. If the stock breaks the trendline resistance, right, on the pennant, there's usually a possibility that the stock may continue moving higher. It all depends, right? Sometimes people trade it on the break of the resistance, sometimes on the neckline. I mean, the trend line depends on what the stock is proposing. It looks very similar to a bull flag. They both have the same exact idea. You can see, if you look right here, stock makes a move up, takes a break. Everyone sees that? It takes a break, forms a pennant, right? It's taking a break. Instead of it taking a break like that, it's taking a break in a different way. It's still taking a break, same exact idea. Makes a move up, takes a break, boom, continuation. Entry point, stop loss. Now, question, I want you to think about this. Here, we obviously want to see high volume, right? Right here, we want to see high volume. What would we want to see here? What would be an ideal situation for this point? High volume or low volume? Once again, right here, we want to see high volume because it's making a strong move up. We want to see that the strong move up has commitment behind it. On this move right here, what do we want to see? Do we want to see high volume or low volume? We want to see low volume. We want to see volume decrease because we want to see that less people are interested when the stock starts consolidating. There's not aggressive selling going on, right? And then obviously when it breaks out, right? When it breaks out right here, what do you think we want to see? Right here, we want to see high volume. The last one we have is called a bear pennant. Bear pennant is a chart pattern that happens when a stock makes a strong move down. It makes a strong move down and then basically takes a break. Very similar to a bear flag. The break looks like a pennant, this break right here, right? If the stock breaks the trend line, this is a trend line support on the pennant, there is usually a possibility that the stock may continue moving down. So the idea behind this pattern, same exact thing as a bear flag. Strong move down, stock needs to take a break. Once it takes the break, it usually continues. We do not make an assumption that it's going to continue here. We only take the trade when the stock chart shows us, when price action confirms that this is going down or up, when it breaks our critical level, when we are able to identify that. So keep that in mind. If you go right here, you can see, look what happens. Stock makes a move down, takes a break. Makes a move down, takes a break. Makes a move down, takes a break, and then slowly starts bleeding, right? And obviously, whenever it starts making aggressive moves down, we always want to see volume go up, and obviously seeing low volume here would be ideal, right? And then now if you take this trade, entry would be on that break. You can see it's breaking the last low, right? The candle is breaking that point, and then obviously your stop loss, depending on the stock, you want to give yourself some room, would be a little bit away from your entry point. Now, the only thing you have to remember about these patterns is if a stock makes a strong move up or down, it needs to take a break. So this is the only thing you need to remember. Forget the names of flag patterns, bear patterns, whatever they're called. We don't care about the names. We care about the idea behind them. Huge move up. So if a stock makes a huge move up or a huge move down, we want to see it take a break. We want to see it consolidate. We want to see it take a break. During the break period is when the continuation chart patterns kick in. We don't care if this is a bull flag, if this is a bull pennant, whatever it's called, we don't care. The only thing we care about is, wow, strong move up, increased volume, volume starts decreasing, everyone sees that, and then boom, volume picks up again on the breakout. Beautiful, beautiful, phenomenal, high probability play here. Well, let's go through the understanding one more time. Strong move up, takes a break, and continues. Very strong and high possibility clean-cut play. Don't care about the name of the pattern. The only thing we care about is the idea behind it. You can see volume spikes up, strong move up, takes a break, look at low volume, and a strong breakout. Let's look at another example. A stock makes a strong move down. We want to see volume spike and a strong move, strong candle. Takes a break. We want to look at low volume here. And then we would possibly see a continuation if the stock breaks. Once again, makes a huge move down, takes a break, continuation. If you look right here, same exact idea. Stock makes a strong move up, takes a break, right? During the break, we want to see low volume, would be very, very ideal. And then at the end, you can see, tends to break out very, very strong. Strong breakout, look at the candles, beautiful candles. Obviously, we want to see high increased volume. That would showcase us strong moves. One more example, look right here. Boom, strong move up, takes a break. We want to see this. This is what we want to see. When we see a stock is taking a break, that's where we go, okay, I'm ready. I'm ready for the continuation play. Stock already made the big move. We missed it. Cool, it's taking a break. I'm not taking on a trade. I'm only taking on a trade if it can break a certain point, right? I want to see my criteria line up. It takes a break. We obviously want to see low volume. And then if it breaks out, what do we want to see? During this breakout, we want to see, obviously, high volume. Once again, strong move up, break, continuation. Same thing as we went over in chart phases in part 3. Now, if you look at another example, look right here. Strong move up, takes a break. This now becomes our critical level known as resistance, known as supply zone. Breaks it, you can see company has earnings, obviously pulls back, has a little sell-off, bounces off our same support level, which was our resistance level first. Now it's support level, bounces, makes a strong move up. Everyone sees that? Strong move up, bull flag, continuation. Simple price action. We're reading simple price action. We don't need anything else beyond that. We see simple moves up, simple break. Break of critical level, that same critical level is now our support point. Makes a move up, look here again. Now if you look here, I haven't applied our critical level, but you can see right around this area, right, we have our critical demand zone. Demand or supply zone, whatever you want to call it, depending on where the stock is. Supply zone, demand zone. Boom, continuation. And here you go, one more example. You can see a volume spike, strong move down. Stock makes a strong move down, takes a break, continuation, boom, bear flag. We don't care what it's called, we just care about the idea behind it. Stock takes a break, and then boom, we see a breakout. Let's understand it one more time. Strong move down, takes a break, continuation, boom, takes a break again, continuation. Let's understand real quick. During this area on the move down and during this area, what do we want to see with volume? High volume or low? We want to see high volume, right? Because look at that move. Look at those beautiful moves down. High volume, beautiful move down. During this move right here, ideally we'd want to see low volume, right? We want to see it be a weak move up and then boom, continuation.